The Managing General Agency, or MGA, has played a pivotal role in the insurance chain for decades. In many ways, MGAs can be considered the eyes and ears for insurance carriers. They know local and regional markets better than the carriers, and it's MGAs who have strong relationships with brokers and agents, the boots on the ground, so to speak. In the growing rush to embrace technology, exemplified by insurtechs, the role of the MGA is rapidly shifting to one of even greater importance, and insurance companies, especially property and casualty carriers, are coming to depend on them even more. The benefit of technology is clearly evident in how fast MGAs can quote and bind and underwrite and issue policies today, relieving carriers of many of the processing costs that help to swell expense ratios. Hello, I'm Chris Henry, and this is Ahead of the Curve, a podcast series about Salesforce technology at work and produced by Gerent, one of the leading Salesforce implementation partners. Salesforce may best be known for its leading CRM platform and technologies that link front and back offices efficiently for various industries. But an acquisition in early 2020 is allowing the company to bring the same game-changing solutions to the insurance and financial services industries. Today we're going to get into why and how this technology is having such an impact on insurers and MGAs, and how it's reshaping the entire field. Our guest is one who's familiar to listeners of our previous episodes on insurance technology, Donn Vucovich. Donn has spent more than 30 years in the insurance industry, creating and implementing technology solutions for carriers and MGAs, and he's currently Gerent's insurance practice lead. One area where change is occurring quickly is within the distribution channel, and I began by asking Donn how that change is impacting MGAs.
Let's start with the most important part of an insurance chain, and that is the customer. Finding the customer, bringing them on board, getting them the insurance policy. That's critical. And what we've seen over the past 20 years is that changing of the distribution channel, the actually merging into one organization, multiple channels from an independent agent, a captive agency, broker, MGAs, to find and bring together all the customers that are out there. The aspect of technology that has adapted to this model is the ability to do an omni-channel approach, which is creating one platform that can handle the multiple distribution channels and the challenges that come with it. So when you look at it, organizations are starting to become more refined around the technology necessary to bring those customers aboard into the carriers through these different avenues. You're seeing that grow heavily in the insurtech space. Much of the money that's coming in is going into the insurtech space around distribution, around bringing people in through a technology platform that's more self-service, that can handle more complex risk, and can be done across multiple different channels. So that's really where quite a bit of the work is being done. MGAs in particular are driving much of this change, given their nature to work across the independent agent channel and bring in business between agents and brokers to the carriers. The need to be able to integrate that on a single platform so that they can see where the risk is coming from, handle the risk at a local level, and then distribute it to the appropriate carriers based on the quotes and the products that they're selling, really in a seamless fashion, is what's going to make or break the MGAs going forward. It's also why we're seeing significant growth in that area.
Because technology is an enormous factor in this changing distribution model, isn't it?
It is. Technology is helping to enable all this to happen, and really is the driving innovative factor in the transformation plans that the whole system from agent all the way through carrier are looking at. Salesforce in particular, and Salesforce Industries, provides two critical aspects to making that happen. And it's based on their capabilities and competencies that they had separately, but now more importantly as one organization after Salesforce bought Velocity and made it into Salesforce Industries, is really the combined platform. The first part is that intake process, the customer management, the prospect management that Salesforce is so well known for. and the ability to manage those contacts, the capabilities, and its statuses and follow-up. That capability has been critical, and many of the insurance carriers, the MGAs, the brokers, have that type of CRM, customer relationship management capability that has been expanding as their footprint has been expanding. Separately, Salesforce Industries really has worked on the transaction once a customer is looking to buy insurance. And that's upfront on the policy side, the ability to manage the quoting, the binding, and the issuance of those policies in a seamless fashion on the Salesforce platform. So when you put both of them together now, you have a solution that allows you to be able to manage the multiple channels from an independent agent, a broker, other venues of customer intake, the ability to actually do the processing transaction to get the insured their policy. And then finally, you have a seamless platform to actually do the customer 360 service, whether that's self-service capabilities combined with customer call-in capabilities, really changes the dynamic of who is managing the customer, who is processing the customer, and then most importantly, managing the customer's expectations for ease of service. So Salesforce has done a great job of hitting those categories, and together they're working hard on combining them to really be able to be a leader in this space, in the insurance distribution space.
Property and casualty insurers make money basically by paying out less in claims than they take in through premiums and investment income. P&C carriers are unfortunately at the mercy of Mother Nature and climate change. Consequently, their losses have been dramatic, and that drives up premiums, which can have a negative knock-on effect on existing policies. But carriers can exert control over their expense ratios, and that's where technology is having a positive impact.
And the expense ratio is a critical aspect of bringing in business. And the life insurance side or the property casualty side, being able to know what that acquisition expense is the underwriting expense necessary to put the business on the books is critical to managing profitability in the organizations. So what you're looking at from a technology standpoint, to start, very simply put, is many organizations have had to, because it's been disparate, have had to buy the same types of solutions 2 to 3 times. So the agency has an agency management system that they're paying for. The broker slash MGA has a agency management customer management system that they're paying for. The carrier has an agency customer management and process management, the actual policy issuance, policy administration that they have bought. So when you look at the full chain, everybody has bought the same functionality across that chain. So in that simple example, that's 3 times X on the same functionality. If you're running it off of one platform or one seamless platform, it really ends up reducing the cost from a technology standpoint of the number of platforms and software necessary to process business. So that's first and foremost. The second part is people. The ability to actually have one platform that can run the stream from upfront customer intake all the way through issuance of a policy allows you to be able to process business in a more automated fashion using some of the capabilities both within the Salesforce tool from a process management and collaboration management, but also the emerging machine learning processing where the standard insurance business doesn't require people to touch it. And so you can move through the chain with very minimal people interaction, therefore reducing the overhead task of having the same people reviewing the policies at 3 different components, therefore having 3x or 4x of expense along the chain. And then finally, and most importantly on the expense ratio, is the ability to identify early on where that risk fits. And I say that because in the old days, we would try to take as much as we can in and at the back end decide whether we like that risk or not. So we've already incurred the volume through that and the ability to manage that volume. These days, a solution like Salesforce and Salesforce in particular helps you manage those edits and that appetite up front at the initial decision point so that it's actually being routed to the people who want that risk, who know how to underwrite that risk, and who have the appropriate pricing for that risk. Therefore, your quote to bind ratios significantly improve, reducing your overall acquisition cost because you're not dealing with the amount of policies that you're declining. Those are the big aspects that are happening within the industry, and how MGAs are playing a role in this. That ability to identify the appetite to be able to place effectively really is starting to be the coalescence point, where the people, the technology, and the process are coming together and being pulled out of the insurance carrier, having duplicative capabilities, and moving into an MGA world, so that the MGAs handle that business and handle the expense of it using the platforms across and extending then to the different carriers versus having three separate types of platforms and capabilities, or more importantly, much more than that, point capabilities across the spectrum.
It's not unusual in the insurance realm to have dedicated agents or captive agencies selling for a single company. In the P&C space, Allstate and State Farm are two examples of that. Very often, such firms provide their own proprietary platforms and software to their agencies. This represents an enormous development cost, along with ongoing hardware and software expenses. So I asked Donn what the Salesforce solution could mean for companies like these.
A good question. The Salesforce Industries and the Salesforce solution really provides a platform that has the scale and capability, first and foremost, to handle these large organizations like Allstate, State Farm, in a cloud-based solution. They are the leaders in that. Secondly, Allstate and State Farm, when they continue to grow and create the captive network, they provide the technology to those captive agents in a way in which has been a software build and release. So many of those organizations have significant spend in the technology space like a software company. However, they really are writing it, their purpose is insurance. So when you move to cloud, what it allows these insurance carriers to do is really provide an independent platform to their captive agency that they no longer have to run the base underlying infrastructure for. Everything from this point of sale on the sales agent desk all the way to the massive servers and server farms that they have back at corporate. All that can be outsourced. And when that's outsourced, then it allows you to plug in cloud-based tools to allow you to effectively manage the process from captive to carrier. So what you're seeing is a shift where in the prior days, you would have significant proprietary systems being built to manage this process. Mm-hmm. Well, as we talked about earlier, the customer is going between captive, independent, and other parties. Your captive agency has to have that ability and flexibility just like the other channels. The Salesforce solution allows you to implement that in the captive solution, as well as these carriers are extending into the independent agent and MGA space, which they have been doing, provide that same platform. Now, this specific solution or configuration, if you will, that Salesforce can provide can be different on each of those channels, which really allows you to maintain that competitive advantage and that brand recognition for what each channel does, and specifically the captive agent providing that local experience and that local capability, and most importantly, the service necessary at the point of customer. Mm-hmm. So this is one of those aspects that from a technology standpoint, really difficult to do 15, 20 years ago. The smaller carriers have been doing it here because they don't have as much of the same captive platform. It's more of a regional basis that they can help roll out. And so they've started down that path. And now the big people, the top 20, if you will, insurance carriers are looking at the Salesforce platform as truly a platform that they can consolidate their multiple channels onto and provide unique experiences by channel and by risk type. So very exciting for where the industry is going forward.
It's one thing for technology innovation to be recognized as a game changer in any industry, but the seal of approval is in how much investment capital the technology is attracting. And insurance technology is attracting plenty of money from a variety of sources. Initially, venture capital and private equity financing flowed into insurtechs, as the seed capitalists recognized a strong opportunity there. Now, more and more money is pouring into MGAs, especially those that have been transforming themselves into digital entities.
Money is coming in from multiple different sources, and they're seeing it as the next bastion of improvement in an industry, not unlike Amazon taking over many of the consumer products marketplace and putting it on platforms that make it easy for people to buy, sell, return, handle issues. Insurance has been one that has been very siloed in nature. And so these hedge funds, the private equity, the money people are really looking at the inefficiency that is in the market and how can they improve the inefficiency and create different models. Distribution is a critical aspect to that. So the money has been flowing, like I said, into the insurtechs to really handle the omni-channel capabilities that are necessary for the next distribution model that's starting to show up. To do that, actually taking capabilities that have traditionally been within the carrier realm and moving them to organizations like MGAs that can specialize in both managing the local market as well as the appetite and underwriting of your standard commercial risk or standard personal lines risk is critical, as well as the specialty lines. So it makes the distribution channel much more effective. And so that model is really being funded by these third parties that really see the upside of how it reduces the expense ratio, how the technology can be leveraged. So it's an increasing returns business, and how the acquisition only adds to the valuation. So being able to bring in companies that are smaller at a lower valuation into a platform that gets a higher valuation due to the investment costs that they put in really is a financial return that these organizations can't ignore. So that is driving a lot of the changes in the model, and the outside influence is really putting pressure on the insurance carriers to change their models in a way that can leverage the capability and the technology, which is why you're seeing a real growth in the MGA marketplace as being a critical component that for many years was on the side for a specific line. Now it's really becoming mainstream as to how to process business and how to manage business.
While MGAs are getting lots of attention these days, we can't forget the wholesalers, whose role in the insurance chain is just as vital. The same impact that's propelling the value of MGAs is also carrying wholesalers along.
Yeah, the wholesalers are absolutely one of the key aspects to making sure those hard to place risks are getting done both from a Lloyd's marketplace as well as on the US carrier basis. And it's the ability to access the market quickly, respond effectively, and place that business with the most appropriate carriers that can handle the risk. Oil and gas would be a great example of a wholesale market that really requires specialized capabilities and understanding to be able to grab that risk from the market, be able to assess it, place it quickly, and respond to the customers who need to handle that well. Ocean marine is another one, freight forwarding type aspects where there's insurance. So the wholesalers having a platform that can quickly be utilized all the way from customer intake through issuance of a policy, they really get to manage and get to see the benefit of that. So you're going to find that they're going to be wholesalers being aligned with carriers, MGAs, and their role is going to continue to increase as these unique risks in our systems continue to increase.
In fact, as new risks continue to emerge, the old ways of covering them have to change too. Endorsements, both standard and non-standard, have worked reasonably well in the past, but as risk becomes highly complex, for example, cyber risk, MGAs and wholesalers today are well positioned to place it.
And so if you go 10 years back when cyber really started coming up from a policy standpoint, we really adopted and utilized other policies to cover that risk in a broad sense. Today, that risk is being more defined, and the policies around cyber then are becoming much more refined in nature and specialized. So what types of risk are we really talking about in the cyber area? Are we talking ransom? Are we talking the penetration risk of somebody stealing key information? Are we talking espionage, cyber risk, depending on the customers and the types of products? And then more importantly, are we talking the chain of information from cyber? So are you a weak link in somebody else's that is in a very significant confidential industry, and you're a third party that provides information or capability? Are you the weak link, and how does that hit? So risks have been emerging, being identified, and placement of those risks, depending on size, are starting to move into the specific categories based on the company's specific risk that they're trying to cover. Wholesalers, MGAs can help manage that when it becomes less the standard placement of small commercial cyber policy risk and becomes more of a specialized capability due to the industry or the carrier and the company that they work in.
Donn believes that the rapidly changing role of MGAs and wholesalers is going to continue to evolve in ways that will prove more and more beneficial for all parties concerned: MGAs, carriers, investors, and the consumers of insurance products.
I think what you're seeing is the MGA becoming the accepted model for distribution. And I say that carriers and MGAs have been learning off of the Florida model and the hurricane model, where the carriers really are providing capacity, and other entities will start to provide that capacity. And capacity in these terms are the dollars necessary to pay the claims, to put up the surplus, to be able to write the policies. So the carriers are becoming much more effective in that, and becoming more effective in paying closer attention to the investment returns that they're getting and operating on the investment portfolio. So the capital allocation, capital resources becoming more the fundamental characteristic of a carrier. The distribution aspect, which is bringing the customers and underwriting the policies, truly, now that the technology that Salesforce brings to the table is allowing them to push that capability to trusted MGAs that are large and know the marketplace to make those decisions for them. And the MGAs then are separate entities that manage those customers and capabilities. So what that allows us to do is it allows us to have specific carrier resource capabilities, capital, specified to segments, that if that segment has a downturn, you still have all the customer information and all the customer interaction in the MGA. So our ability to switch from carrier to carrier becomes more effective, and the ability to leverage the resources, the capital resources, becomes more refined, allowing for better returns across the channel. So MGAs are going to be a much greater player going forward. They are going to be the marketing entities. It will still take time, but that's where the insurtechs have been driving the market. The technology platforms are allowing for it, and the carriers are becoming much more comfortable because of the access and the ability to push their appetite, the underwriting rules, the necessary way to look at a risk before accepting it, to organizations that match and manage what they're looking for.
It's hard to have a clear picture of how all of this will end up working out, but we have a lot of clues. We know that technology is pushing major change in an industry that's been slow to shift gears and slow to increase revenues and profits. We know that the technology is attractive enough to bring in millions of dollars of investment money, seeking and finding a sizable ROI. We know that MGAs are adding a lot more muscle within the insurance chain and offering carriers the means to focus on their capital resources by shifting more and more processing responsibility to the MGAs. And all of this, to date, has been highly successful. You've been listening to Ahead of the Curve, produced by Gerent in cooperation with Salesforce. Thanks to Donn Vucovich, Gerent's insurance practice lead, for insight into the changes that are reshaping property and casualty insurance. Technical production from Dave Grine and the Acme Podcasting Company in Toronto. I'm Chris Henry. Thanks for listening.